Hey traders, let's get on with the Forex trading series. This one's going to be video 8, which is Elliot Wave Structure. And by the end of this, I'm hoping to confuse the hell out of you guys. Um, let's hope not. In previous videos, you've heard me speak about impulse waves, corrective waves. I think I've termed them acting tides, and tsunami waves are the ones that we want to be trading. Also, you've heard me speak about multiple levels of rise and fall. So when the market is trending up, then we're looking at 3 levels of rise and 3 levels of fall. We've talked about the fact that the market itself establishes itself in structures. It just doesn't go straight up or down. There are times when the market will go straight up and down, and that would possibly be corrective waves that happen after our 5 level structural movement. So 3 levels of rise, 2 levels of corrective waves, and then you've got your larger corrective waves that happen. So how do we see them? You've heard of Elliott Wave Structure before. Many of you are probably struggling with it simply because when you follow the rules as it's outlined, so many of the times the rules won't apply. And after the fact, when in hindsight 2020, you'll be able to see and say, yeah, the market still did move in this direction, still kind of had those formations, but it didn't quite meet the rules. So I'm going to be breaking some of the rules. And when it comes to trading, yes, some of these beyond your own criteria rules are meant to be broken. Okay. Before we jump into that, there's a couple of things that I want to clear up. The first one is that in the previous video, we have spoken about this reason, the very core of why we conduct technical analysis. Okay, and the simple reason is simply to determine the trend. Okay, I'm hoping you guys have seen that video and that's helped you clarify your approach to your methodology in technical analysis. And the other thing that I want to talk about is that where a lot of the times you hear this term about market makers being in control, right? I know Steve Marrow's got a course on this as well. Look, some of that is correct, but if you are under the impression that market makers, which are essentially liquidity providers, about 1,600 of them, um, and the big 5 or 10 of them are the ones that we would call market makers because they're the ones that really have the big bucks to push the market or establish structures in the market that we'd probably recognize overall, right? But this notion that those market makers are in control of the market all of the time is entirely false. And that would explain why, when we're looking at the markets at times, we don't know what the hell it's doing. Okay? What you're seeing on your screen is effectively the remnants of transactions that have already happened. Okay? And those transactions set the real-time value of the currency pair that you are looking at or trading, and it's just the value of individual currencies against each other. That's it. This candle here within this 15-minute scope, which has got about a minute and a half left in it, that's real-time transactions happening right now. That's all it is. Okay, so when we then look at, say, a structure forming, which is something similar to an Elliott wave structure forming, usually that's when we know that some of the bigger liquidity providers that we'd refer to as market makers, that they are at play. Okay, don't try and apply that all of the time, because with so much of what goes on in the $5 trillion market, the bigger players aren't at play all of the time. Okay, so what I mean by that is to say, once we've delved into Elliott wave structure, I don't want you guys looking at the counts and saying, okay, this is 1, 2, 3, 4, 5, ABC. Where, hold on a second, why didn't this just do what I expected it to do? Because right here, right now, this is just simply transacting. Okay, so and the market makers really aren't at play. And why do we call them market makers? Simply, they've got the big bucks. They've got the ability to move the market in a manner in which the rest of us can't. Okay, $5 trillion market. It takes literally thousands of lots to be able to make or move the market 1 pip, depending on currency pairs that you're dealing with. Okay, so be familiar with that. Now let's delve into Elliot Wave Structure, and the core of it. Once you understand how Elliott Wave Structure works, you'd be able to predict to a large extent where the market is going. And also, in the next video, when we start talking about patterns, right, you then learn where to apply patterns. Okay, so let's jump into this. I've pre-drawn a picture in just so I don't look like an idiot in real time drawing this. Now, Elliott Wave Structure basically says that the market's going to rise and fall, most likely in 3 levels overall. And then there's going to be a bigger correction that happens. And within those 3 levels of rise, there's also going to be 2 pullbacks that tend to happen, right? And this can happen falling as well, where there's going to be 3 levels of fall in the market. So up here, it'd be basically saying that it's also potential. The market's going to fall in three levels. There'll be 2 corrective waves that happen here, and then an overall correction that tends to happen as well. Correct? This will usually follow something like this. So if the market has come down and it's done its corrections, then what we're then expecting is that this market's going to move back up and climb in 3 levels. Now, overall, this is the Elliott Wave Structure. The structure can be broken down into structures within structures. Okay, so we'll have a look at that shortly. And then there's a number of rules that apply to this structure as well. We'll look at that now as well. Before we do, once again, rules, in my opinion, are meant to be broken. And when you're trading the markets dynamically in real time, then what you're going to find is that the hard and fast rules don't actually get met in real time. Okay, so let's look at this. We've got 3 levels of climb, okay, which are called impulse waves. We've got 2 retracement waves. These are the corrective waves that happen. And then after this 5-level structure is completed, we've got another massive correction, which is broken down into A, B, C. Okay? Now, if you were to study Elliott Wave Structure, and I think I've got a book on the website, if I'm not wrong, that you can download and you can have a read of, this will go into so much more depth and will confuse the hell out of you. But for all intents and purposes, for what we're doing, whatever I'm about to say, this is just it. This is all you've got to be able to follow. Okay? Now, here's the thing, that each layer or each level that the market follows through, so let's say this is the first level, and then this is the second level, and this is the third level, right? Each level will also, as above so below, will go through its own 5 levels of movement plus corrective waves. So in this whole area here, what you would find is that the market goes up, down, up, corrects, and then comes back down again. This correction from that point to this point here is exactly what happens from this point to this point. So in the first level, what we're expecting is this correction will come back down to 61.8% of this overall move from here to here, okay? And how you can determine that is with the use of your Fibonacci tool. So you'll have your 100% line here and your 0% line up here, and then you determine the correction. When do you start looking for this? Is when this market has reached a peak and then starts to fall back down again. Okay, so when it's coming back down, that's when you put your fibs in and you can then reasonably predict where this market's going to come to. We're hoping that this is going to come to 618 area, right? Chances are sometimes in real time that this will probably come towards the 50. You might get you might get a wick to the low at 618 here, right? But there are also going to be so many times, and this is my variation to the rules, where this price will come down and hit also um, the 786 line, or somewhere in between the 618 and the 786 line. A lot of traders tend to have their pending orders placed somewhere down here. It's whatever they predict, the market will hit somewhere here and then go up. Okay, and in the next video, we're going to be talking about the actual patterns, like how would you recognize that the market has actually reached that specific point and then it's starting to climb again. Okay, so I'll come back to this. And the same thing will happen, all of this, same thing will happen here. The only difference is that when the market retraces back here, which is this bit here, from this point to this point, we're expecting that the market to only come back to the Fibonacci lines of 382% or the 50%. The rule is 382, but for all intents and purposes, this is my own variable, where price can come anywhere between there and here, right? I've even seen it try and come down to the 618 area. Usually speaking, that would nullify this structure, because the rule to Elliot Wave Structure would be that that when the market retraces back, it does not break past where it started from. Okay, so it can come down to 786 or possibly even lower, maybe give you a wick to the low, but not to the point where it started from. It's also stated that this here, which is level 3, is going to be exactly 1.618% of, or 161.8% of this move here, from here to here. Okay, and you can use your Fibonacci Expansion tool for that. Okay, and how you would do it is you would have your Fib 0 line drawn in here, your 100% line here, and then this will extend out, and you'll either have 127 somewhere here and 1618, something along those lines, right? So to some extent you can use that to predict where the market's going to go. This part here, though, where this is going to be exactly 1618 of this, in real time, I've not always seen that to be correct, and a lot of traders do get into trouble because they're trying to be very specific. And I'll show you an example with Pound USD about what's happening right now, where you'll understand what I'm talking about. The other thing is that one of the rules will state that this level 3, that you have the second wave of the climb, is the longest wave out of these three, 1, 3, and 5. That's something else that I haven't found to be correct 100% of the time. So you're going to have to be dynamic in how you approach this. A lot of the times I see people where when they are drawing these lines in after the fact, they will extend it out to ridiculous levels because they'll say, well, this is what the market has done. Oftentimes it just means when you're looking at it with the benefit of hindsight, it can't be correct. So like, how would you be able to predict what the market's about to do if what you're looking at right now makes absolutely no sense? Okay, and the third rule is that when this fourth wave, the corrective wave here, that it does not come back into the territory of the first wave. So basically saying that this does not come to this point. If it does come to here and bounce off, then that possibly isn't Elliot Wave Structure. But again, there are times when I've seen the market push back and use this as a support line and then go back up. So to some extent, if the market gives you a structure that you recognize here, sure, you could trade that and get your 20 pips out. But if it's a 382 bounce here and then the market's going up, then certainly you can aim for more than a 20 pip rise. Okay, in all cases, if you are trading the climbs, right? So especially from this point here where the market goes and makes its level 1 impulse wave rise, corrective wave down, and then you've recognized the 618 area, the market gives you some sort of a confirmation, a pattern, and then starts to rise. Wherever your entry is going to be here, your stop loss will be right below that. So about 10, 15, 20 pips, right? Generally speaking, what I like to have is maybe a 20-25 pip stop loss. And that way, what we're effectively saying is that if the market comes back down, it probably will come back down to do a retest of this level, and it won't keep going down to your a lower level. So even if it's like a 786 hit here, then your stop loss would be slightly below that, right? And as the market starts to climb, what you will do, and the market will certainly climb in levels. So remember how I said earlier, as above, so below. Even this third level climb, or level 3 climb, it's going to be broken into waves like this, right? So what you would do is, as this market moves up here, and your entry might be here somewhere, as it moves up and then it claws back slightly for one of its own corrective, smaller corrective waves, and then goes up, then what you do is you move your stop losses to the same thing, 10, 15 pips below this level. And as the market moves up again and climbs up again towards this point here, then again you do the same thing. You'd find this pivot and you would move your stop loss up here. And this is what we're talking about when we say where you trail your stop losses, right? So you move it up here, and in any case, if the market does come back and does its corrective here, which it will, you've got a couple of choices. One, say for instance you've captured 50, 60, 100 pips by then. It's your choice to get the hell out of there. Generally speaking, once you've done this and the market's moved up here and over here, this is when the pattern formation starts to happen. That's when you will probably look to exit your trades, because what you can do is, when you recognize this, if you were a swing trader, which you can do, you can trade both ways, is exit out of that trade, wait for the market, or enter into the market where it's retracing back to a certain point before it goes back up again, right? So you could trade that, capture your 20, 30 pips that way, and then be ready for the market to climb towards its the fifth level structure. Okay, and once it does that, again, you take your entry, and it will most likely repeat the 3 levels, smaller levels as well, before it gets to the very top here, right? So you do exactly the same thing that I've discussed here, over here, okay? Once it gets to that point here, which would be your peak, you'll get out of that trade again, and then ready yourself for this drop here. Now, with the smaller structures, the drop that happens here, which is usually coming back to 61.8% of this initial move, they're smaller moves. Like, you can get 30, 40, 50 pips out of that, right? But once the market has created a 5-level structure on a higher time frame, then what you're going to get is one of our big king tides, or our tsunami waves, I should say. I think I'd call these ones our king tides. This one would be a tsunami wave that happens. And the reason for that is this overall structure, ABCs, will most likely retrace back down towards the 61.8 line of this move here, so the level 3. So again, what you would do is you grab your Fibonacci tool, okay, and this would be a 100% line. Draw it all the way up to this point here, and you would mark where your 618 line is, right? And when this market starts to fall, you probably take your entry, right? Once you've taken your entry, you could probably exit here. But these are one of those beautiful trades where you can take your entry, let it fall, let it consolidate slightly, or do a reversal or a pullback, and then let it fall again. And your target price should be somewhere towards where 618 area is of this line here. Okay, and oftentimes this could be a few hundred pips, right? Or at least a couple of hundred, and that may happen in the space of about 2 days or so. So you could probably look for that sort of a setup. Capture your 20s or 30 pips moves here. You'd probably capture 30 to 50 pips easily or more here. This could get you close to 100 or more. Same thing here, where we're talking close to 50 pips. This one would probably get you a couple of hundred pips. And all of this will be dependent on currency pair. Okay? Now, I'm just going to quickly touch on patterns in this video, and then I'll come back to the next video and talk about the same things slightly. we often talk about our double tops, our double bottoms. We talk about head and shoulders patterns and your cup patterns, but no one often really talks about where you place them, right? Too many people are looking for these your double tops, your double bottoms everywhere, and that really doesn't apply. Realistically, where you should be looking for them, say for instance market's trending up, you've got an Elliot Wave structure being established, you're looking for your double or triple bottom patterns here, here, and here. Okay, you're looking for your double top or triple top patterns up here, or up here, right? You possibly will get something slight here, and then down here we're looking for massive W formations or triple bottom formations, right? You could also get a head and shoulders pattern here, same here, here, and here, right? More often than not, you will get a head and shoulders pattern here. A lot of the times, you will get them here as well, but your double tops and your triple tops are the most common. Okay, and even here, very slight ones. You're most likely to have your wedge or triangular pattern formations happen here. So this sort of thing. Okay, that sort of stuff. What you'll also find is your channels, right? So if the market is kind of trending up, what you would find is your channels would be this way, and you will have channels this way, and you'll have channels this way, and you'll have channels this way, and the same thing, okay? Confusing? Fantastic. So we will jump into the patterns more so later on, but that's usually within the structure is where you're looking for these sorts of things, right? In the next video, I think I'm gonna talk about a shortcut as to how to decipher where you are within the whole Elliot Wave structure. I think because that's utilizing more of patterns. It's basically just to say that when we get our triangular formations happening or larger wedges happening, what we tend to get is that a count establishes, and these counts most likely tend to happen either on the fourth wave correction, or we get them at B corrective wave structure, right? So there and there, usually if we see it, we recognize it, then we can go back, zoom out, and then see how many big movements we can see prior to that. If we can count 5 waves or 3 structural moves up, then we'll say we're at B level formation. If we can only get 2 of these or 3 levels of movement, 3 waves, although confusing you and myself. If we can only get 2 impulse waves, then we'll say we're at fourth wave, which is the second bunch of corrective waves. Okay? All right, now I hope you are confused as hell. What we're going to do is get out of here, and then I'm going to jump into pound USD and run you through what the market has actually been doing in real time. Okay, so zoom out, and we'll go into a 1 hour chart. Okay, now, actually I've just forgotten one thing that I want to touch upon quickly. Okay, EMAs. You guys know that I love using EMAs with my trading. What you're going to find a lot of the times is that when you are trying to count Elliott Wave structure, remember when I talk about where the EMA 50 and the EMA 200 cross per se, right? So we've got the 50 going up, right? 200's here, and then the 200 and the cross happens, right? Usually what we'll get is this bit here is below where the EMA 200 and the 50 crosses, right? So when I talk about where the cross happens, the market goes up and then consolidates and it's finding its way back to the 50. That usually happens in the smaller Elliott wave structure. So if it's at the 50 where the market is, it's gone up and then it's consolidating and it's coming back towards the EMA 50 and then bounces back up, and then again it will find its way at the EMA 50 and then it bounces back up, and then what you find is that this time round it will break the EMA 50 and then come back down, correct? That's what you will see. So this is why in my videos you probably heard me speak about where I'm actually looking at possible 2 hits to the 50, and then on the third hit I'm looking for a break towards the 200. Okay, so that whole combination of break, go up, consolidation back to the 50, go up, consolidation back to the EMA 50, go up, break, and then come back down. That in itself is just the first level and second level of the overall Elliott wave structure, right? Now, any guesses to once it breaks the EMA 50 here and comes down towards the 618 where it's going? On the higher structure, it's going to the EMA 200. Okay, so on the higher structure, this would be, on the lower structure, it's going to the EMA 200. Right, so on the on the higher structure, this would be EMA 200, maybe on a higher time frame, like your 1 hour chart or the 4 hour chart. Okay, so that's the reason why one of my entry points, my kill zones, is yes, we're going to, when we're doing the cross and we're doing the counts, we're going to be taking entries off the 50, but after at least 2 hits to the 50, I'm expecting this to fall back, and once it does, then I'm expecting to find some sort of a setup happening around my EMA 200 here before the market climbs again, right? On your 15-minute chart, so, and this sort of a structure happens on all of the time frames. So if you're getting this coming down onto your EMA 200 on the 15-minute chart, what that means is that is possibly 1 or 2 hits to the EMA 50 on the 1 hour chart. Okay, and again, as you go on to higher time frames, this EMA 200 on a 15-minute chart would be your EMA 800. Sorry, EMA 800 on a 15-minute chart would be your EMA 200 on a 1 hour chart, and an EMA 3200 on a 15-minute chart would be your EMA 200 on a 4 hour chart. So without confusing you guys even more, basically just saying that within the whole Elliott wave structure, when you get these multiple hits to the 50, this is actually the 5-wave structure just sitting within this level 1 and 2 wave structure. And once it comes back to this point here, that's going to hit the EMA 200. Okay, and then the same reapplies again. So this will go up and this will come back here. This point here will come back at the EMA 50. This will be the EMA 50 again, goes up, and this corrective wave here will come back to hit the EMA 200, right? And then same thing happens here, 50, most likely 50 again, and then correction back towards the EMA 200. But this time, on the 15-minute chart, this will break right through the EMA 200, and guess where it's going to go? On the 15-minute chart, this is going to go to the EMA 800, which is the EMA 200 on the 1 hour chart. And so when we see that break happen, and we're expecting it, we will then wait for this to hit the EMA 800, and once again, we're looking for some sort of a pattern formation happening at the EMA 800 before it climbs again. Okay, and once it does the climb again, well, chances are that is either the first or the second hit to the EMA 200 on that higher time frame. So if it's the first hit, then on the higher time frame, we have just hit the second end of the Elliott wave structure. If it's the second hit, then we've just hit the 4th wave of the Elliott wave structure. Okay, let's go have a look to see what this looks like in real-time chart. So I'm on the 1 hour chart for pound USD right now. Okay, see this here, this red line? When the markets start getting very rough, what I start doing is I start adding more EMAs. Okay, by far the only tools that I love using when it comes to price action for me are my EMAs and the Fibonacci tool, right? So on a 15-minute chart, this red line here to me represents the EMA 200 on a 4-hour chart. So this would be a period 3,200. We'll do it at exponential close. Okay, and this beige looking line here on a 15-minute chart would be a period 800. Okay, exponential moving average, and we'll apply to close. Right, and you can choose whatever colors you recognize. But when the markets start getting rough, this really helps me determine where my kill zones would be, and also it saves you from having to jump from higher time frames to lower time frames constantly. So if you have a look at where the price is right now, if I go on to a 15-minute chart, and we know price is behaving strangely near the EMA 3,200, which is the red line, right? So what I'm expecting, if I jump onto the 4-hour chart, is to see that this is the second hit to our in this case, after the market has bounced off here, it's the second hit to our EMA 200 on the 4-hour chart. See how on a 15-minute chart where the price is? That red line represents the EMA 200 on the 4-hour chart. So what I would expect here is if I can do my Elliot Wave corrections properly, or my analysis of Elliot Wave structures properly, I should say, sorry, is that then I can determine if this market's going to bounce off here and go up this way, or it's going to continue down towards this. Now, once we get to the 4-hour chart, these beige lines and the red lines mean nothing, okay? The only reason why I've got that there is simply because I'm looking at what the EMA 200 looks like on the 1-hour chart and the 4-hour chart. So once you get to a 4-hour chart, ignore these lines here. We're only paying attention to what our EMA 200 is doing. Okay, so let's go back to the 1-hour chart, zoom out a little, and let's have a look to see Elliot Wave structure. Okay, all right, so market's done its thing up here, and you've always got to make sure that before you start doing your calculations as to where this market is going, if you're looking at a start point, you always go back to see if the market gives you some indication of a structure that it followed when it came back down to this point. So see these channels that I've drawn in? I've got a high here. So the market climbed, reached a high here, and then this was structure 1, structure 2, and I'm going to call this structure 3, before it actually corrected. All right, and then this correction of the EMA 200 here is now officially for me the beginning of this movement going up, Elliot Wave structure. But and you can look at trading this. You wouldn't know how far that was going to go unless you looked at previous structure up here, and you could say, okay, we've got structures here, so this would most likely hit a wall somewhere around here. But for our extents and purposes, what we're going to do is we're going to see, first of all, that the market, and I tend to utilize my EMAs as starting point. So see on a 1-hour chart, right, this here would represent the EMA 200 on a 4-hour chart. Okay, this would effectively not mean much on a 1-hour chart, but notice how price does come down, respect it, and that to me here looks like a W formation or a double bottom formation, stop hunt to the low, and then the market starts to climb. Once you've got this, market comes down, does the retest, and it's doing its thing, it's climbing, right? Now, in real time, you'd be looking at this and thinking, yeah, but I've just missed it, I forgot it, how do you know? You don't have to, because the thing is, you're going to utilize this bit of information to be able to trade all of this, right? So the market moves up and then it hits an invisible wall, starts correcting. This is where it enters into a channel, right? And we can start using some information in regards to Elliot Wave Structure here to be able to determine to what point this market's going to go. So what you could do is a number of things. You can grab your Fib tools, and usually what I like to do is I don't count my entry somewhere here. I'll count it once the market has reached a retest level, an EMA or something around those lines before it starts to climb. So at the beginning of this Asian session, I'm going to go all the way up to the high that the market's created, right? First rule of the Elliott wave structure is that I'm expecting that this second or the corrective wave, which is the second wave, is going to come all the way down to my 61.8 line, right? We can grab our horizontal line, drop it to where the 61.8 line is, and maybe even get these text tools and start writing in 618. Right, start writing notes, because over time what you're going to find, and notice how it takes a number of days to set up, right? So if, say for instance, you started seeing that the market has hit its high here, a double top formation, and started to fall, and you're trying to predict where it's going to come to, you might have done this well and truly well and truly a number of days before it actually reaches that point. So draw that in, write it in, because you'll forget. And if you've got a trading journal somewhere, for that week, you might just put down week starting Monday such and such. Pound USD is in most likely level 2 Elliott wave structure formation. It's entered into a channel and it's coming towards the 618 level. Something along those lines. You'd probably write that down so you'd recognize it. The other thing we're looking for is this. When the market has done its climb of level 1 structure, we're wanting to make sure that there is a pattern formation somewhere here. See how in this case there was a double bottom formation, right? And then once the market gets to this level, this top here, what happens is that the market will most likely give you a double top or triple top or a head and shoulders pattern. Okay, once you see that and the market starts to fall, you could probably trade that coming down towards either 382 mark. Okay, that's 81 pips there. You could do that towards the 50. That's 118 pips. Or you could do it towards the 618. That's 1,540. 154 pips, right? And this is where you look for your king tides, sort of, where the market will do a retest and then starts to fall. Okay? That's how you would look at it. Now, this is where you would also find the market behaving strangely. It enters into a channel, does all this sort of crap. So you will grab your channel tool. So let me get rid of this so I can show you. Grab your channel tool, right? And roughly draw in what you can see. So say, for instance, the market has done its thing up the top here, and it's done this and it's done this, right? So what I do is, with my channel tool, I will draw in that point, and these 2 points would be hit, and then I'd leave it there. Okay? And you can, as time goes on, so say for instance this has happened, the market has gone up, it's hit it, and it's behaving this way, you can correct this. So you can correct and say, okay, I'm going to move this slightly up, and then what you find is the market comes up here, goes back up again, comes down here, and you might say, look, I need to correct this slightly a little bit more so that it's hitting my points, right? Move this back down again. And this doesn't have to be 100% correct. It can be rough, and the reason for that is that all you're doing is you're going to count points. So within the whole Elliott wave structure, corrective wave structure, within this whole scope, what you're looking for is possibly 5 hits, okay? A, B, C, D, E. And what we'll do is we'll say, okay, this point here, once we've got that double top or head and shoulders pattern or triple top, something happens and the market begins to fall, and this becomes our like a dynamic trend line, or just a trend line. whenever it hits that point the first time, that's our hit, right? This becomes B. We're expecting it to come towards this again to hit our C, D. Once it comes back towards this area here, and this is after it's done its deformation and the market is channeling down, I'm expecting now that this is going to create some sort of a pattern for me that I would like, hit this point again, and then start to climb, right? Why? One, I'm expecting that this bit would be the second wave of my Elliot Wave structure, which is the whole corrective wave. I'm expecting that this is going to come back down to 618. I'm expecting, just going on from our diagram there, that on a higher time frame, if this is doing this, that it will come back down to my EMA 200 now, right? So this beige line is EMA 200 for me on the 4-hour chart. Remember, once it's done its 5 layers here, and you're in a larger corrective pattern, and usually what you'd find is when it's breaking the 50 like this and going up, and oftentimes this is where you'll see where prices are both above and below the EMA 50, then you know it's going to come back down and break the EMA 200, most likely on a higher time frame. Okay, so in this case, we've got now points of confluence that's happening. One, we've got our 618 line, we've got our beige EMA 200 line on a 4-hour chart, and we've got a hit to our trend line down the bottom here. So once this bounces back up, that's when we can say, okay, chances are this is going to break free and then continue going up. A lot of traders wait for entries here. You could take an entry on a retest here, but for us, this would be the best entry once it's kind of hit these points of confluence, right? If we jump onto a 15-minute chart, okay, that's what it looks like on a 15-minute chart. All of this nonsense here, okay, all of this is what we see on a 15-minute chart, right? And this takes a great number of days. So here, see how price reached this level, 3 hits to this high and then fall? This sort of stuff you could trade, right? So you've got price is going to get to this stage and you're expecting a fall. Where? London Open, New York Open, okay? If it's doing this and it's starting to fall, you can trade this. Your B, B, C, D. Okay, we can again New York Open. Notice how the price drastically falls. Okay, it comes down to this point and it consolidates. Again, we're looking at about three hits to the low or so at our confluence points before the market climbs. So let's have a look to see what that candle looked like when it climbs. So notice here we've got some tweezer bottoms, and then again, and this is at London. Market price completely rejected and stalls at our trend line here, and then aggressively moves up. So this is where you would take an entry. Okay, you would have waited possibly a week and a half to be able to take this entry, but that's where you take your entry. Now, by the end or the start of the Asian session, you're about 64 pips in the money, right? And you keep trailing your stop losses. So once the market's done this corrective here, you'd probably bring it down to just below the EMA 50. And notice how price constantly comes back and retests the EMA 50. That's what I was talking about. When the market comes back and bounces off the 50, you can continuously move your stop losses below there. Okay, so let me get rid of the fib tool so it doesn't look so busy. All right, so you could possibly look at trading this all the way up as far as this market's going to go until you see a 2 hits to the high, right? So here, and the 2 hits to the high will happen in multiple sessions, okay? So if you could probably count this one, market comes back down, goes back up to hit this. It's 267 pips in 3 days. You could trade that way, or you could look at multiple entries every time price comes back to hit the EMA 50. Okay, so now what we find, and realistically, again, jump onto a higher time frame. so we can do this, is utilize our Fibonacci expansion tool once it's down here to be able to predict where this market's going to go to, right? Again, you've got a couple of options. You could do it from down this point, but I will likely do it probably here. This point's okay, but you could probably do it here as well. What you do is, as soon as the structure reaches its peak, hits a double top, so it hits your invisible wall and starts to fall into a channel, that's when you draw your expansion tool in, put the 100% line up there, your 0% line down here, and then wait for price to come down, hit the 618 and start to climb again. What you can project is that when the price goes up, first of all, it will hit the 100% line. Okay, without a doubt, it will hit the 100% line. And what I would be expecting is that it will go and hit the 127 line and possibly, again, do some sort of a retracement back, right? It retraces back down, and then it will go towards our 1618 line. And this is where I'm saying would become a variation to our Elliot Wave Structure, because one of the rules would be that price is going to go at least from this point to this point, right? Retrace back to 618, but from here to here, it would say that price will most likely climb to 1618 of this level here, okay? And then go do a corrective wave structure. In this case, what it did was, this was level 2, this is level 4, went up, and then gave us a triple top, and then here's a corrective wave structure. Remember where I said it will break through the EMA 200 and come to the EMA 200 on the higher time frame. So when you get that sort of like a sharp decline, that usually means that we possibly are in corrective wave A after a 5-level structure is hit. If we are in level 2 or 4, what you will get is this sort of behavior where the market is just going to trend or channel, right? Not trend, it's going to channel. In this case, where the market does this, does the consolidation on the 200 and then falls again to go towards the EMA 200 on a higher time frame, chances are that on this particular time frame you have reached the 5-level structure and you're in corrective wave structure here. Okay, and so on a 4-hour time frame, that could potentially mean that in this case, what it could be is that this now becomes level 2 or level 4 on the 4-hour chart. Okay, and that's how you can utilize where this market is actually heading. Play around with it a little bit, and when we discuss patterns in the next video, then what we'll do is go into the little tricks as to how do you determine which level of the Elliott wave structure you're in. And in saying so also, like, you know, this is where the variations come in very handy, simply because there are times when the market's not going to follow the exact structure. If we were to utilize this and say, I'm going to push this down lower, right, and use this to be Elliott wave structure 1, and say from this point to this point is my 3rd level, right, and this would be the 4th level corrective wave structure, and it could be, right? So let's do this. Let's get rid of this. Actually, no, let's do this first. Let's draw in where my 1618 level is. Get rid of this, and then say, using Elliott Wave Structure, Fibonacci tool, that this is where the correction will begin from, right? Because this is where the 618 has hit, and then the price falls all the way down towards 618, right? This is where, if I was to say, well, hold on a second, this should have been where the market should have come from, right? And this would now be level 4 correction before the market goes to level 5. keep this in mind that if it was level 4 correction, what you would find is that price will only come to 382 mark or even the 50 at max. It will not go down to the 618 area, and nor will it go to the EMA 200 on the higher time frame. Okay? All right, so guys, I'm starting to get confused. I'm hoping you guys aren't confused. If there are any issues, then certainly just comment below and I'll create another video around this so this makes more sense. Okay? All right, guys, that's it for now. This is a long video. Go grab yourselves a cup of coffee, go have a cold shower or something. All the best.